Let's talk about some non-traditional funding options for your business and get creative. My name is Jane Rich, and I am a business advisor with the Northeast Indiana Small Business Development Center. In today's session, we're going to understand what types of non-traditional funding sources might be available for your business. We're also going to learn how to identify these alternative funding sources and additional ones that we may not yet identify. And we'll discover ways to improve your cash flow and access ways to obtain even more funding sources. What are your options for non-traditional sources of cash and non-traditional sources of funding? What types of non-traditional funding sources are there? There are many, and we've only identified a few today, so please think about what other alternatives might be available for your business. I'm going to give you a breakdown of several of these and then go into a little more detail. First, we have vendor and supplier credit. Purchase inventory on terms or on credit with your suppliers. Business credit cards. Personal loans from the owner to the business. Personal loans from other individuals to the business. Factoring accounts receivable. Barter exchange associations. Leasing and seller financing. What do some of these mean? Vendor terms or purchasing items on credit from your suppliers can be a truly effective way to support your cash flow needs for a short period of time. Your suppliers want you to be successful, so you will come back and buy from them again. You can work with them in developing strong relationships by communicating your needs, explaining your cash flow cycle, and having them understand and become a vested partner with you in operations of your business. So many times they will be willing to negotiate terms of more than 30 days for product that you need to use in your business. Vendor credit may require the personal guarantee of an owner, so you need to make sure you read the terms and conditions closely. Another source are business credit cards. Remember, match what you use for debt with what you need it for. If you're using a business credit card, it should be only for short-term needs, items, expenses that you can pay in full on a monthly basis. Examples of these would be travel, entertainment, and office supplies. Business credit cards get very, very, very expensive if you don't pay them off in full every month. Know what your rates are and know what happens if you miss a payment. Be careful to manage the use of business credit cards by traveling employees. Oftentimes, balances creep up before you know it when employees are on the road. You need to have set limits and clear communication on what credit card should be used for. And do not use credit cards to purchase equipment for a business unless you have already identified a more permanent funding solution. Many times people need to use credit cards to acquire assets over the internet, but take it off that credit card as soon as possible and put it on a term loan. Definitely have it paid in full within that month. Personal loans from an owner or from other individuals to the business need to be treated just as if it were a bank loan. It needs to be documented formally, in writing, with stated repayment terms, stated interest rates, and maturities. Treat a personal loan to a business as if it were from an outside or institutional lender. Make sure it's documented and formalized. If you don't, and if you don't have a set repayment or a set interest rate, the risk is if you are audited, it could be reclassified as equity, and the ability to repay it could be greatly diminished. Factoring is a way for a business to sell its receivables, its accounts receivable, to a third party to collect those receivables. It's a bird in the hand beating two in the bush kind of funding source. You can sell what is due you tomorrow at a discount today. You need to be able to check the pricing and understand fully the costs to sell or factor the receivable. When you sell it, typically you receive anywhere from 68 cents to 85 cents on the dollar for every dollar of receivable that you sell. You need to know what the total cost is. And if you were going to be able to receive that receivable payment within 30 days from when it was sent, it might be more expensive for you to factor it to get the money today instead of waiting 2 or 3 weeks for payment. And understand what happens if the receivable you have sold does not get collected by the factoring or purchasing company. What happens if your customer is unable to pay them back? Do they sell it back to you at face value? You need to know. The term for this is if it's sold on recourse. Seller financing is also another way to provide gap financing or interim financing to allow a business access to an asset or to purchase an asset with limited equity down payment. Many times real estate is financed in part or in total with seller financing, where a business pays the owner of the asset over time or a period of time until it gets enough track record where it can get it refinanced with a bank loan. Also, seller financing can be used as a form of mezzanine financing, which was discussed in an earlier chapter, where let's say a business is buying real estate, a bank is only willing to give 70% of the value. The owner may only have 10% of the value, so maybe the seller would be willing to finance the remaining 20% of the value on a note. What other kinds of creative options can you identify for non-traditional funding? Look within your industry, talk to associations, talk to your suppliers and others that you interact with to find out how they have identified creative funding sources. If you have any additional questions about getting ready to apply for a loan, please feel free to contact me. Again, it's Jane Rich, Business Advisor with the Northeast Indiana Small Business Development Center, and our office number is 260-481-0500, and my email address is jrich@isbdc.org.